Hey everybody, Joshua Phillips here at Churchill Mortgage, sending out a market update here in the middle of the week. I haven't sent one out in about 10 days, and I thought what's happening right now was worth going ahead and making a video. Now, I send these out for, of course, my clients, my wife Amy's clients, sometimes my son Jesse's clients. Basically, if you're working with a Phillips here at Churchill Mortgage, you're in great hands. So anyway, well, and let me say this, my goal in sending out these market updates is to inform people. It's not necessarily, it's hard to share bad news. I'd love to always be hyping that rates are getting better and better and better, but unfortunately, that's not always the case. And unfortunately, that's not the case right now. So I always like to start with some CNBC articles here. Boy, the articles are not good right now. You can see here on the 19th, a couple days ago, mortgage rates crossed back over 7%, which is true. That was when the U.S. Credit was downgraded, and then mortgage demand drops after interest rates jumped to the highest level since February, which is mainly what I was going to focus on. That was out today, and today has been a particularly bad day. If we hop over here where I started, 10-year Treasury, U.S. Treasury, you can always check that out yourself. Look at the yields. We want the yields to be going down, not up. So mortgage rates got at their best levels in the last 2-3 years back last September. If you want to just look at a visual, that was back here. 10-year Treasury yield at 3.64. Awesome. And then we kind of went on this run where rates were going up, up, up. And we got to about 4.8 back in January after Trump was inaugurated. Then we had a nice move down, and since then we've been back on a upward trajectory, and we're back almost at 4.6%. We really need to see those 10-year Treasury yields back under 4%, but unfortunately they are rising. One other chart I'll show you here, we always like to go to our mortgage-backed security chart. Very similar, although this is kind of the, you got to think it through. We're seeing this is a mortgage-backed security chart where mortgage rates derive their values, and what we want to see green. We want to see security prices going up. So green is good, red is bad, and the higher the security price, the better mortgage rates are doing. And again, you're going to see a lot of red. You're going to see this is the last 90 days. You're going to see that we're dropping back down here recently to the worst levels we've seen in several months. If we pull out here to a 6-month chart, you can see again we were a little bit worse back in January. Rates were a little bit higher, definitely over 7%. We're kind of back down. So boy, it's not been good, and a lot of it just has to do with our national debt, the issues with tariffs. There's just a lot to unpack this year. Also, the Fed's not lowering the Fed fund rate, although the Fed fund rate's not mortgage rates, as I often will say. But it has not been good news. So hopefully things will hold at this level, and we need a bounce back. We tried to bounce back here in April. We did get a little bounce back. Rates improved. We were kind of back in the high sixes. Maybe here, we go back to here, we might have gotten to the almost the mid sixes, but now we're back over 7% as that article was showing us here on CNBC. So what do? First of all, you take a deep breath. We have seen rates as high as 8% in the last couple of years. So 7%, while it's not ideal, it's still reasonable. We would love to see rates getting, really into the sixes, into the low sixes. But man, the market just doesn't seem to care what I think or what I want. It just does whatever it's going to do. So, we need some of these things to resolve. The reality is inflation has improved. So I don't know. I think there's just concerns about inflation in the future with tariffs. And for now, rates are sitting around or a little over 7%. If you're looking to purchase a home, you just need to be aware of that. If you're looking to refinance, you're going to be waiting a while. I've been telling people 6 months to a year. I think, unless something dramatic happens, I think it's going to be a while before rates really dip down to where most people, where a refinance would make financial sense. Well, as I often say, if you want to have a personal conversation about your specific situation, your specific interest rates, fees, and your qualification, we're happy to do that with you. That's always obviously the best way to get accurate information, is to have that conversation. So, and I'll throw in one last thing, bonus fry here at the end. We have been utilizing a lot of 2-1 buy downs. A 2-1 buy down is something that the seller has to pay for, but that does lower the rate 2% the first year, 1% the second year, and then you're back to the normal rate the third year and beyond. I am currently working on my third 2-1 buy down this year with a client. It is a nice way to kind of soften the blow and give you a couple of years to kind of ease into the full payment, and with the hope that maybe even you could refinance in those 2 years. So that just came to me as a little bonus fry. 2-1 buy down as a great strategy right now to help make the payment a little more reasonable for the first 2 years, while we hope to see, hopefully, rates come down in the next couple of years. All right, take care. Let us know how we can help. Have a great day. Bye-bye.